Hi, thanks for your interest in the Shared Equity Home Ownership Program. In this video, I'm going to introduce you to a strategy that may help you achieve your dream of buying or building your own home. Did you know a self-managed super fund is not only the fastest growing but the largest sector in the superannuation industry? Let's say you have about $250,000 in your superannuation, which is currently held with a retail or industry fund. Today, you can choose to take control of your super and manage your own investment assets just by rolling your funds over to a self-managed super fund. Once you've set up your new fund, you gain the opportunity to move all or some of your current superannuation into a SMSF structure. SMSF stands for Self-Managed Super Fund. So in this example, let's say Mark has $250,000 in his current retail superannuation. He chooses to move $100,000 into an SMSF, leaving $150,000 in his current super account. So $100,000 flows from his current super into the SMSF. Now, he can control and choose his own investment assets worth $100,000 inside his SMSF. Mark chooses to invest $100,000 into an unlisted property trust. So, $100,000 flows from his SMSF into the property trust. This is your SMSF making an investment into the property trust. In return, you expect a return on your investment. In fact, many retail and industry funds already invest in similar property trusts. The property trust is expected to provide an investment return as a combination of both income and capital growth, which flows back into his SMSF every year. So as you can see, Mark via his SMSF has made an investment, and now he's got a return on his investment, and that's step 1. Step 2, Mark wants to build a new home for him and his family. Unfortunately, Mark hasn't saved the required deposit, and he wants to purchase a $400,000 home. Mark can come back to the property trust as an individual separate from his superannuation and nominate a property of his own in which the trust can invest. So $80,000 would flow from the trust to Mark in the form of a loan. This loan will be at a fixed interest rate for the first 3 years. However, it is paid up front for Mark by the property trust, so he can pay more off his principal during the term of the loan. This gives Mark the opportunity to pay more principal off his first mortgage, and if his property has increased in value, he can then refinance to pay off his loan with the property trust within the first 5 years. This is called a shared equity loan. Any increase in the property value, Mark will share 20 to 25% of the capital growth at the time of refinancing or selling the property. Mark can now use the $80,000 to act as a 20% deposit for his new home, which is our micro deposit strategy. Mark can now apply for an 80% loan from a bank. Now having a 20% deposit, Mark is able to avoid paying expensive lender's mortgage insurance, which is a massive savings. That's step 2. Mark has now got a loan from the property trust. Now Mark and his family have moved into their new home. They have always wanted to get out of the rental cycle, where the children could paint and decorate the walls, his partner could design and landscape the garden, and Mark could finally build his shed. Now, their family dream of home ownership is now a reality. So I just want to highlight what Mark is not doing. He is not buying a property by directly using his superannuation. Mark is not doing that. What he is doing, however, is making an investment, which is step 1, and then getting a loan, which is step 2. Having SMSF is not for everyone. There are responsibilities in managing and investing your super money in an SMSF you need to consider, that if not done properly, can result in significant penalties. Before setting up an SMSF, you should seek advice about the suitability of an SMSF and the strategy for your personal circumstances. Please contact us for further information and assessment of suitability.